We are live. Yes, welcome everyone. Thank you so much for joining us for this super exciting jam session, our third jam session at the Defiant. This one is all about synthetic assets. And for that, I mean, who else do we have but the top founders of the top synthetic asset platforms? So I'm so happy that you guys could join me for this chat. We have Kain Warwick, co-founder of Synthetix, Hart Lambur, co-founder of protocol, and Kwon, founder of Terra and its mirror synthetic asset protocol. So I will like to start by having you all explain what the benefit is of having synthetic mirrored assets on decentralized finance. So basically, what all of your platforms do, right, is replicate what traditional financial assets do, or how they move, like in the crypto world. So you take a traditional asset and mirror it in a crypto token trading on a decentralized exchange. Why is this an important and useful thing to have? Like, why not just go buy the actual Apple stock if you want? And maybe Kain, you can start.
Sure. I think the primary benefit that I see is that you can have all of these different exposures to different asset classes in the same place in a crypto native format, right? So, in our case on Ethereum, you can have exposure to gold, oil, equities, Bitcoin, a range of different assets that you would otherwise need to go to multiple different venues to access. And so, in terms of efficiency and like user experience, it's much nicer to be able to just turn up to one place and have access to all of these different assets, which is the reason why, things like Uniswap have done so well, right? Because all of the tokens that you want to trade are in one place, as opposed to being spread out across, a range of different platforms.
Totally. Joe or Hart, anything to add?
I'd zoom out maybe, Cami, and talk about just the global nature of what we're talking of how this works. So even zooming out and looking at decentralized finance more broadly, if you think of traditional financial products and services, they're like shockingly regional. So you actually see insurance is only offered to U.S. people in the U.S. Robinhood is only offered to U.S. people, even though they've been trying to expand internationally for a long time. And like, why is that? Why are traditional financial products so regional by nature? And for me, the answer is that the enforcement mechanism for all of these traditional financial products is actually traditional legal recourse. So it's actually based on your own legal jurisdiction. That's the only way you can get access to those products and services, which is why the financial products offered in the US are not actually the same as in Canada or Australia, even though these are all relatively similar countries. And they're not the same as what's in Korea or anything like that. And so what's so cool about synthetic assets and then decentralized finance generally is that we've actually created financial products and services that are enforced by a blockchain plus economic incentives. And that enforcement mechanism is actually like global by default. It's internet native by default. And so this is sort of maybe the more nerdy side point to what Kain's saying. We now have like truly global financial products and services, which I think is super exciting and actually almost seems inevitable, given that we're in the internet age and stuff is internet native and global by default.
Totally. So what do you think?
Yeah, I would say that the main benefit of Synthetix is that it takes assets that were previously super boring and then turns them programmable. So you can take a synthetic asset from any of our three protocols, and while how they maintain pegged is a little bit different, you can plug it into any protocol in the DeFi stack, and then inherits all the benefits of what that DeFi protocol can do. So, for example, like if you plug the synthetic asset into a lending protocol, you can replicate an experience by which a user can earn interest seemingly magically by holding price exposure to, let's say, a commodity or, say, like an ETF or something like that. So basically, like the things that you can do on top of these synthetic assets sort of exposes the user to the infinite powers of DeFi. That's really exciting.
I didn't think I could get more bullish on synthetic assets, but I think I have in the last like 3 minutes. It's impressive.
Yeah, no. To me, I think what's most interesting about synthetic assets is that it just brings any financial asset to anyone in the world, wherever they are. I think kind of that's more to Hart's point, how like the global nature of these cryptocurrencies. I think it's a bit hard to kind of get that when you're in a developed nation and have like access to just like a broad array of stocks and bonds and things to get exposure to. But I always tell this story about my brother kind of always being into stocks trading when we were growing up. And, I'm going to like date myself, but like we were growing up when like Facebook was becoming popular. And my brother, I don't know, at like 10 years old, he was like, oh my God, I wish I could own Facebook stock. Like this thing is going to be huge. But of course, like we were like kids growing up in Chile. There was no way we could ever like have bought US stock. Like you'd need a US bank account, a US broker. But now like that's available for anyone anywhere in the world. So I think, and that's, thanks to synthetic assets like what you're providing. So I think that's an amazing use case for DeFi in general. But how does this actually work? Like how are you able to replicate how like Apple stock moves in a cryptocurrency token? I don't know who wants to take this.
I mean, it's a hard one, Cami. I think all of our protocols have different ways of doing this.
Yeah, actually, like if you can each explain how your protocol solves this question, that'd be great.
Sure. I'll go first and actually say that what Uma's building or has built is a bit different than Synthetix and Mirror here, where we're really building infrastructure to let developers create their own financial contracts. And one type of financial contract is this synthetic token, or this idea of a token that effectively tracks anything. And that's another kind of core difference from what we're doing, where we're building the infrastructure to have these financial contracts or these synthetic tokens be infinitely programmable, where you can kind of track anything. We've built examples of this where, or rather developers on our system have built examples of this where, for example, we have a token that tracks the price of gas on Ethereum. And we are actually working more towards other tokens. These almost look more like structured products that can be used to diversify DAO treasuries by letting people borrow against them and create things that might look like convertible debt or some sort of other kind of financing structures. And the way we do this is, in some ways, it's maybe a bit simpler than the systems of how Mirror Synthetix work, where we have a contract that looks a lot like single collateral DAI, looks a lot like the maker DAI system. We have a contract that holds collateral. The creator of the asset has to maintain a collateral ratio, otherwise they get liquidated. And at an expiry date, the synthetic token will settle to be worth whatever the payout function is. So if it's going to be gold, it'll be worth, you can have it set to be worth an ounce of gold, or it could be worth the average gas cost of Ethereum on the network, or whatever the payout function might be. And so our system looks a little bit more like a single collateral DAI type system with an expiry date. But I won't go deeper than that here.
Okay, that's super interesting. So it's like the fact that you can redeem your token for collateral at a set price sets kind of the market incentives to price that token at the price where you can kind of redeem the asset at, and that price is set to like equal whatever financial asset that's tracking.
Exactly. So there's this concept of arbitrage here, where if that
Mhm.
asset, if the price of the synthetic token is trading at a price that's too different from what the ultimate settlement value will be, arbitrageurs can do things to keep that in line. So
Right.
they can make money to keep that in line, which is how it's closer to how traditional futures work, where futures
Mhm.
can trade at prices different than the actual underlier, but there's an arbitrage opportunity to keep them in line. Um, and the advantage of that is that we can really do this on anything. So we are not limited to creating synthetic assets that track known things. People can invent their own and can literally come up and have it create a synthetic asset that tracks, you know, the number of Twitter followers that you have, or the TVL of Uniswap or something like that.
Yeah, it's so cool. I remember, like one of the first times I wrote about UMA was about how you had created a token linked to the like San Francisco poop index or something like that. So I thought that was amazing that you could just like take anything and make a token out of it. But it's a bit different from futures in that like the expiry price needs to change. Like it needs to be tracking something that's volatile, right?
Yeah, but futures do the same sort of thing too. It's again,
Yeah.
without going to like a gold future tracks the price of gold, right?
Oh,
So
right.
the gold
You're
future
familiar.
will settle to the spot price of gold at some future date. And so the idea here, what we've spent a lot of time and energy doing is developing this infrastructure that lets us be very generic here and lets developers build their own. And
Right.
so a bit different from Kain and Do, where like we actually can have bespoke or long tail, like people can create their own random weird thing, like this token that tracks the amount of human excrement found on the streets of San Francisco. Like you can actually build that.
Amazing.
But yeah, it's a good example to compare and contrast to the designs of Synthetix and Mirror.
Yes. Kane, how does it work on Synthetix?
Yeah, so rather than using kind of arbitrage and kind of counterparty trading, where you can have these exotic assets, which obviously is really cool and something that I think is very useful in an efficient market for people to be able to construct these kind of long tail assets. We take external prices via oracles using Chainlink and push those prices in, and the guarantee that you'll be able to redeem the asset for its underlying price comes from the fact that you've got this over collateralized pool of assets. So there's this a set of pooled counterparties that are essentially guaranteeing your ability to redeem the asset at its underlying price. So it's probably a more complex structure in the sense of there's staking and people need to maintain their collateralization ratios, and there's a number of incentive layers to kind of ensure that redeemability to the underlying price. But the pricing mechanism is fairly straightforward. You just push a price in, and that is the price that the asset can be redeemed for at any given time.
I'm not sure I get kind of the difference with the like UMA protocol. You're still kind of you have an asset that you can redeem at a certain price, and the reason that you can redeem that is because there's an amount of collateral in the system. So what's kind of the specific difference?
So the difference is at any given time, the latest Oracle update is the redemption price. There's no need for arbitrageurs to come in and trade against some pool or like it just literally you say the price of Bitcoin is $40,000 right now, and I've got one synthetic Bitcoin. I can convert that into 40,000 synthetic US dollars instantaneously.
I see. Okay. So it's like the way that the token is priced is the difference. It's like UMA depends on arbitrage, Synthetix depends on oracles, on the Chainlink specifically.
Fundamentally, yeah, that's the big difference.
Got it. Cool. Okay. Do, how about for Mirror? How does it work?
I think if I added like a third mechanism to the mix, it's gonna be super confusing.
It's interesting. I'm learning so much.
Yeah, I think we share the similarity with Synthetix in the sense that it's not like a futures-like contract. So there is an external oracle which reads the prices, and you can, and that which is used as a reference to incentivize arbitrage, but it isn't used as a reference point for you to be able to settle out to anything. So for instance, like at any given time, you can mint a mirrored asset with the Oracle point price as the reference points and putting in over collateralization. But when you're actually exiting out of that position, you need to either A, close the position explicitly, or to sell it at a decentralized exchange. So I would say the principal difference that we have with Hart's UMA design is that there's no explicit expiry, right? Like at any given time, you can mint mirrored assets, you can close mirrored assets. Those prices are used from some external Oracle as a reference point. But the key difference with the Synthetix design is whereas the people that have created these synthetic positions sort of share global risk in the sense that there is one global pool of collateral that is backing some global pool of debt. Ours is 1-to-1, so there's one position that is backing one pool of debt, and then margin calls are responsible for just each of those bespoke positions.
Okay, so the difference is that instead of having one pool of collateral with many kind of stakers adding to that, and that's kind of backing all the assets in the platform, in Mirror, it's whoever mints a specific asset is putting up collateral for that, for their own specific position, not for the protocol overall.
Right.
Got it.
Yeah.
Okay.
Yeah, Camila, I'd add this is actually kind of useful in compare and contrast. So the Synthetix model is pooled. So there's one debt pool that mints all the assets, right? Mirror and UMA that is not pooled. Like we have each asset has its own minter. You mint that specific asset. You don't mint kind of globally, right? And then Doe's design doesn't have a concept of an expiry. It has no expiry built in by default. And I mean, there's actually very interesting questions around what are the arbitrage mechanisms that keep it in line. But that's a different question. So I'll stop there. It's a useful compare and contrast you've set up here.
Right? Yeah. I mean, this is the whole idea of the jam session. Get people in the same space, kind of discussing their own protocols. Okay. So though, like, does the way that the tokens keep their price, is that, you said that's also relying on an oracle, or sorry, I missed that, or an arbitrage, like on UMA?
Yeah. So as Hart said, there's an interesting observation that you can make when there's no explicit expiry with at some predetermined time and at an Oracle price. So if you think about it, like how Mirror works is like very similar to MakerDAO, where you have some sort of pool of capital that is backing some pool of debt, but with MakerDAO, the persistent problem has been that the supply, but the pace at which people mint DAI hasn't always been able to keep up with the pace by which people mint DAI. So the downside of this approach is that on the upside, sometimes it doesn't peg very well. So persistently, we've seen problems where mirrored assets trade at a slight, or in some cases a meaningful premium to whatever the underlying prices were supposed to be. So that's been pretty interesting.
Doe, I mean, I'm actually very curious about this too, if you guys have solutions and ideas on how to solve for that, because there is I'm actually quite curious, because there is potentially, I think there could be some structures where if people really, really want the synthetic asset, it trades at a premium. And I think that a lot of the farming and liquidity mining incentives are designed to kind of counteract that. But do you think there are circumstances where that premium could just persist kind of indefinitely?
Yeah, so what we've used to solve the problem in the short term is to introduce a short farming pool. So you can mint a long position as well as a short position, and then the rewards calibrate between the different pools depending on the size of the premium. So that is fairly effective at bringing the premiums down. These days I think M asset premiums haven't deviated by more than like even when it's really volatile, maybe like 120, 150 BP. But as like a long-term solution, when the yield farming incentives disappear, that could still be a problem. Yes.
I mean, Maker is the example of where like a premium persists indefinitely, right? Like until you start jamming USDC in there to kind of arbitrage it, right? So it's definitely, I think in both Mirror and Synthetix, this idea of, even though within Synthetix, SUSD and SBTC will trade at the Oracle price, you may not be able to exit SUSD at the price, right? And we've had this persistent premium, for quite a while as well, that, something on the order of like, 100 basis points or 150 basis points. So it's ironic, I think, that much of the skepticism around these designs in like the early days, like going back to like 2017, was around the idea that they were traded at a discount. And yet we found that like, it's actually a persistent premium that's more problematic, which, structurally, I think kind of speaks to the overall demand that the market has for these assets. But I think eventually, fine tuning mechanisms, we can get them a little bit tighter.
And it sounds like the solution would be somewhere relating to the collateral itself. Like you said, having USDC with Maker kind of helped DAI price a little bit closer to peg. Maybe oracles. I don't know. Like where do you think things can be optimized?
Cami, it's a really interesting mechanism design problem. Generally, like at a high level, where it's if you go back and you think of perpetual swaps that exist in like on BitMEX style perpetual swaps, they have this concept of like this funding rate that gets paid from longs to shorts or from shorts to longs. And that funding rate is that's what's used to keep the perpetual swap in line with its underlying index. So it's what balances supply and demand. What's really interesting when you create tokens, right, is like, this is the problem of the premium, like for Maker DAI. For tokens, if you have a token, you can't charge the token holder money if there's too much demand for that token. You can.
It just breaks everything.
Yeah,
like,
okay,
literally everything. Right? Like we tried that, it doesn't work, right? Like so. Yeah.
Kate, you're right. But the idea of like I have a token and then I have less of a token, it's very problematic. Whereas when that's not the case in a margin style account, which is like perpetual swaps, where I actually have a margin account and I can just take a little bit of money out of that to make a funding payment. Right. So fundamentally, what like that's where all these different things come in, where what Doe's suggesting Mirror is doing right now is they're using an external incentive, which is their funding rewards, to try to, I'd argue, Doe, and maybe you disagree with this, but they're trying to kind of emulate a similar incentive structure to make up for this funding payment.
That's
but frankly, yeah. So there's just frankly
like negative funding rate, right? Like an extrinsic negative funding rate that you're pumping in the system to balance the supply and demand.
Right.
Wow. I mean, it sounds like so like in theory simple. Let's just like replicate whatever Apple stock is trading at on kind of a cryptocurrency token. But when you start getting into it, to actually get the pricing to be exactly like it is in the original underlying asset, it's really complicated. So yeah, you guys are solving some kind of tricky questions, but fundamental questions for DeFi, for our interesting DeFi use case, which seem to be under really intense scrutiny these past few days. I want to touch on what SEC Chair Gary Gensler said about crypto derivatives and synthetic assets. I'll read out what he said. In a hearing, he said, there are initiatives by a number of platforms to offer crypto tokens or other products that are priced off of the value of securities and operate like derivatives. make no mistake, it doesn't matter whether it's a stock token, a stable value token backed by securities, or any other virtual product that provides synthetic exposure to underlying securities. These platforms, whether in the decentralized or centralized finance space, are implicated by the securities laws and must work within our securities regime. So it sounds like the SEC is saying synthetic assets are securities. What's your reaction to this?
Cami, can I just edit that first part? The SEC is saying at least some synthetic assets are securities.
Yes.
The one part that I want to just really highlight for a second, because there's like a lot of hot takes out there that I think I think this is nuanced.
Yep.
SEC cares about securities, so like stocks, single name stocks, and bonds. But they don't care about, or they don't have jurisdiction over indices or commodities or other things. That's not their domain. So I think there's a lot of people that can reinterpret the scope of this, where what the SEC cares about is that Americans are not buying unregistered securities. And so that would be like Tesla and Apple would be good examples. Once you any stock. What's interesting though is an index of stocks. So if you actually have 10 or more securities in an index, that's actually not considered a security anymore. That's now an index. So there's like a lot of nuance in the rules here too.
But aren't ETFs regulated by the SEC too? I mean, that's an index of tokens.
So
of like securities, I should say.
Again, stocks. More nuanced, because an ETF pools a bunch of securities into a single investment vehicle. That single investment vehicle is considered a security. But for example, as an example, derivatives on the S&P 500 index are not regulated by the SEC.
Right, derivatives, CFTC, I think, right?
Yeah, correct. In the US, at least. I mean, again, this is just US regulation. So it's just super nuanced. Is the one thing that I just wanted to start off with, where I think what Gensler is very clearly saying, though, is that he doesn't, he thinks that tokens that track a single stock, like Apple or Tesla or something, are problematic. Leave it at that.
I think there's another component that maybe some people got, but I think some people missed there, which is the increasing diversification of stablecoin collateral, which in my view, I think is a far more problematic issue than, maybe a synthetic equity token that, has a few, $100,000 worth of open interest, right? You're talking about something like USDC that has tens of billions of dollars in circulating supply, and was originally pitched as, going to be backed by directly dollars in a bank, and over time the kind of profit motive of the foundation, I think, has kind of caused it to get more and more interested in expanding the scope, I suppose, of what that collateral is, and that's problematic. Like that, I think that's not the value prop that was kind of pitched initially, and so you can imagine a scenario where something like USDC is backed by a whole range of structured products and all kinds of things with the sole intent of generating yield, right? Because that's where the profit from the, it's a free service, right? So, if the product is free, then, you're the product, right? And so ultimately holders of that token end up being the counterparties to this basket of exotic collateral that's backing it, right? And I think that is not necessarily something that the SEC is going to be super excited about, particularly when you look at the scale of some of these stablecoins. So, as much as I think TrueUSD was probably the most aggressive about saying that we're going to go out and try and chase yield and, build like a yield generating asset. They kind of pared that back, but USDC, that wasn't the original pitch, as I recall, and they have gotten more aggressive over time with that. So, to me, when you look at the totality of that statement and where the risk lies, the stablecoin issue feels much more of a concern than synthetic equities, for example.
Sure, it's a bigger concern in the sense that there's a lot more stable coins outstanding than synthetic stocks outstanding, and they represent a huge share of crypto volume in general. So I agree, like that is kind of like the bigger fish to fry for the SEC, so to speak. Um, and I agree. It is interesting that I think people in this space have kind of assume that Tether is kind of the shady stable coin and not backed like 1 to 1 to fiat dollars. But then we saw disclosures on USDC on like how Circle is backing USDC, and that's not straight 1 to 1 to dollars either. So I think that was pretty surprising to me. Like they're backing USDC with U.S. Treasuries and commercial paper and other stuff. So yeah, I agree. That's kind of problematic as well. But like, let's not kind of dance around like the issue here, which is the SEC is like clearly concerned about the tokens and assets that you are offering in your platform. So like, what does that mean for you? Like for you going forward, like what happens if the SEC decides to regulate and try to enforce, actions on synthetic assets on, I don't know, Apple mirrored Tesla, or like likewise on the Synthetix. Like, yeah, why do you do like what are your thoughts on that specifically? Like maybe Del, you want to go for this one?
Yeah, I mean, so it is an evolving regulatory landscape, but what I will say though is, I mean, even if these things were considered securities, and in our case, it wouldn't be the SEC, it would be some local equivalent, let's say the FSS, wanted us to shut these products down. I think the same can be said of Mirror, of Synthetix, of UMA, that there really isn't all that much that we can do to shut down the protocols that we built. So in this case, like we would, be the inventors of these various different systems. But as to whether, we're able to do anything about the systems that we built, I think it's like a separate issue. I think for most of us, like we don't actually operate these platforms or to profit from the way that these platforms are running. So really what we could be held liable for is expressing freedom of speech by writing code.
I think that's kind of the general argument for decentralized finance, right? Like you're offering a software, you're not even custodying users' funds. You're not kind of compiling information about your user. So, the question is, okay, like regulators can come and just like force you to, I don't know, provide information about your users or register as as an exchange. But I mean, how can they actually do that is the question, if you're not kind of like handling people's money or like handling user information at all.
I mean, we saw. Sorry. Like we did see this. We've seen this movie before, right? Like it happened with Ethereum. There got to a point where the regulators basically came to the conclusion that Ethereum was sufficiently decentralized that it was outside of the scope of their jurisdiction, because it was not going to be enforceable. It was software that was running on tens of thousands of computers spread all around the world. You can't shut Ethereum down, right? And so that network that's running software that's been deployed, once deployed, you can't shut that software down either. So long as the underlying incentives keep the network up and running, and so long as miners keep mining, and when we transition to proof of stake, stakers continue to validate the network. The software that is on Ethereum today cannot be stopped. It doesn't matter what you say or do or how much you dislike it. It's just the nature of the network itself. And so, obviously there's a lot of nuance in exactly what that means for every single piece of software that's running on Ethereum. And there's various kind of gradients, I guess, of like how decentralized that software is. But for a contract that's deployed on Ethereum, you can't get it off. It's there. It's out of the hands of anyone.
Right. So I guess like the logical step for DeFi protocols to take is to become more and more decentralized, right? So it's just harder for regulators to enforce any of these actions.
Yeah, I think that is you want the mechanisms to stand on their own. And I think, Uniswap is a good example of this. Like the core Uniswap protocol itself, it truly is unstoppable, right? It really, really is. That might not be said at the front end or other things like that, but the core protocol is really unstoppable. Cami, the other thing to add though here is there's other strategy around, do you actually just even want to go there, right? And maybe you can't stop this, right? But synthetic equities do seem to strike a nerve with some regulators, and it's the kind of thing that hey, maybe that's something that the broader DeFi community wants to shy away from in the short term, or I don't know. And I'll let you know just from our perspective. So in my opinion, no one has actually used the UMA protocol yet to create something that would the SEC would consider to be a security. We haven't actually done like a single name stock or anything like that. And I'm actually like that position because I don't really want to have, I don't think it's a bit of a distraction having this conversation when really we want to just build this unstoppable financial infrastructure. And so the other point I just throw out there that I think is worth considering is where do we want to take the conversation, and how much do we want to ruffle feathers, put it that way.
Agreed. And this is, I guess, the interesting question that our communities need to kind of answer, right? There's no one individual within Synthetix, within the community that can say which assets are supported. The network from a governance perspective is decentralized. So the only way you would be able to unwind the existing synthetic assets that are on the platform is through the governance process. Now you could do it, the community could decide, yes, Hart is right, this is not a fight that we want to have, let's actually unwind these, and the community could delist them, but there's no one individual that a regulator could approach and say, you need to switch this off. There would need to be some compelling argument to the community more broadly, right? And in our case, that's tens of thousands of token holders. So reaching consensus on going down that path that Hart's kind of described of not maybe putting assets out there that could trigger regulators, it's a hard thing to even contemplate, right? Most of these communities are spread all around the world. They're not necessarily concerned about the jurisdiction of the SEC or any one particular jurisdiction. So it's a very interesting and open question about how communities themselves will respond to this kind of pressure, I think.
Yeah, will be interesting to see. So are all your protocols run by token governance? Are token holders deciding what goes into each of your protocols and kind of running things, or I guess where is the kind of the risk that you're each seeing? Where's kind of a centralized point in kind of your structures that you think could be decentralized further, or that kind of you're watching as kind of a potential risky centralized point? Though for Terra and Mirror, how decentralized is it? How much control do you have over assets traded there?
Yeah, so So for brief context, I run I created a sort of a layer 1 blockchain called Terra, which specializes in the issuance of algorithmic stablecoins. And then Mirror and Anchor and several other things or applications that run on top of this blockchain that I also happen to create. So for Terra, there's a sort of a native staking asset called Luna that it's been around for a while, and I hold some and things like that. But the interesting thing about Mirror is that from day one, we just created a governance token called MIR and gave over complete control of the protocol to that asset. And then we just gave all of it away. So actually, I don't hold a single MIR token. I received some through the airdrop, and I just gave it away to like employees and friends and different things like that. So it's been kind of interesting because the MIR price did really well from inception thereafter. But it was kind of interesting because, like, to be honest with you, I never thought it would do that well. And then it was kind of entertaining seeing it go up and then realizing that I don't have any. So,
oh no.
That was pretty funny.
Yeah.
I think you're gonna be okay, though.
Yeah, I'll be fine, but it is still interesting.
Yeah.
I mean, I think Synthetix is pretty well known as kind of pushing the boundaries of decentralized governance. It's something that we've been working on for a long time. Like a lot of projects, we started as an open source software foundation, but almost 2 years ago now, that foundation was wound up, and control was handed over to token holders. So in terms of like the sophistication and complexity of Synthetix governance, I think it's maybe like Yearn is close, but I don't think there's that many other protocols that have kind of pushed the boundaries as far as Synthetix has. And it's been interesting to watch because as that process has gained momentum, the community has pulled control further and further away from any kind of centralized aspects. So, there really is very little left in terms of, I guess, attack vectors that you could look at for, protocol capture. And it was something that at the beginning was really important to me. And I kind of committed when we launched the foundation that it would eventually decentralize itself. And we aggressively pushed towards that pretty early. I think earlier than a lot of other protocols. And I think we're, as a community, pretty confident in where we're at in terms of our governance structure these days.
Well, you've removed yourself from your benevolent dictator mode.
For good or ill, yeah.
And Cami, just to finish the compare and contrast here, like the UMA protocol itself, and we should do a better job of promoting this, but it really is controlled by the token, all the parameterization of it. And our architecture is actually quite interesting, where what the UMA token holders vote on are what price identifiers, basically the types of prices that the Oracle system can return. But then actually creating the contracts that use those prices is completely permissionless. Anyone can go and deploy them. So it's a really interesting architecture in some ways, where the only thing that the protocol is really voting on is, hey, what prices will we respond to? And then past that, it's completely permissionless who uses it. And so again, it's like, it is really interesting when you do think about these things where they do seem pretty unstoppable. And that's, I mean, again, as kind of founders, it's kind of scary because you don't really know where these things go. Scary in a good way. So.
Okay, so it's interesting. So it seems like all of your kind of reactions to statements from regulators is, well, the protocol is run by our community, by token holders. We, helped develop the software, but beyond that, like, we don't have any more say really about kind of what's going on, what assets are traded, how people are trading them. And it's, it'll be hard to enforce these regulations if it comes to that. Is I guess like generalizing the basic kind of reaction.
I think certainly for Synthetix, that's a fair assessment. You know, the network is decentralized. It's governed by token holders, and we've even put significant systems in place to ensure that large token holders don't have an undue sway over the protocol. So even if you were to round up the top 10 token holders, those people don't even have sufficient voting power to push a proposal through. There's significant checks and balances that are in place, and that's specifically to ensure that you have a much wider consensus in the community. So yeah, it is very difficult to get a proposal through that doesn't have consensus within Synthetix. So.
Nice, very cool. Okay, and then related to this regulation discussion, obviously, is what Uniswap Labs recently did to not to remove some synthetic assets, asset like tokens from its front end. So around 100 tokens were removed. Many Synthetix based tokens. So how will that impact the growth of your protocols? Like Uniswap is the biggest decentralized exchange, and they are obviously reacting to the regulatory pressure. What are your thoughts on that, Kain?
I think the market has already solved that problem. I genuinely could not tell you the last time that I went to the Uniswap front end, and certainly not like the Uniswap hosted, Uniswap Labs owned front end. Most of my trading activity goes through liquidity aggregators. Even if I'm pooling liquidity, I'll usually go to like an IPFS version of Uniswap to pool liquidity. So I think the market has solved this issue of like centralized front ends being a choke point to accessing a protocol. There's multiple different aggregators, there's multiple different pathways. You can go to Etherscan and access it if you want to. So it's, there's a lot of different wallets which have their own interfaces to the contracts, direct integrations. We've kind of solved this choke point problem over the last 2 or 3 years, I think.
It does kind of limit though you have to be a bit more kind of technical or not technical, like know where to find these aggregators. Like I think like most like first time or new users would come to Uniswap through its own interface, no?
Possibly. I mean, a lot of the volume that goes through if you watch on-chain transaction activity, very little transaction activity happens in a single pool these days. As in, like, most of the transactions are routed through multiple pools. And the reason for that is that, there are so many different AMMs out there that if you go directly to Uniswap, for example, it's very rare that you're going to get the best fill. So, unsophisticated users, maybe, yes, are going to Uniswap, but I think people very rapidly find out that, going through aggregators and other interfaces is a much more efficient and a better way to access those liquidity pools.
Though, Hart, like your reactions or takes about Uniswap frontend?
I mean, I thought it was like interesting enough to joke about on Twitter, but to be honest,
what was your Twitter hot take on this? I missed it.
Oh, my thing was, the uni emoji, and then and then the sushi emoji, and then there was some
I see.
equivalency being established in between, but that was a joke. Uniswap is great. I think very innovative company. But yeah, like I would have to concur with Kain. It doesn't really matter that much. Like very few people are going to come on Uniswap and then be like, like, let's see if there's like a mirrored thing that I can look up on the platform. Because yeah, people are just going to come to Uniswap, and then you might look into some of the top traded assets like Ether, or switching between USDC and Tether and different things like that. But it's very rare for a user to come to Uniswap to look up a specific synthetic.
It's not a discovery engine, right? Like it's it's at best a trading engine. It's not where you go to discover things. So
That's a good point.
And especially with V3, it's turning into more of a sort of a like a underlying infrastructure layer for AMMs, and then there's going to be like a bunch of different exchanges that are built on top of it. So, yeah,
So like I agree with both Kain and Do in that like I don't think it really matters in terms of this specific thing, but I guess I'll maybe take a bit of a different take that it is like there is this trend that any front end, or there could be a trend, it could be a thing that any front end needs to do things like this. And what we don't want is for DeFi to become this like dark corner, we don't want DeFi to be the dark web. That's what we do not want. That's not good for any of us, right? And like the thing that I really will criticize the regulators for is the regulatory uncertainty under which we're operating under, right? Which is it's just not good for anybody, right? But we have like true innovation here that is like doing useful things and is really, really compelling. And we don't want to force it to be like the equivalent of like the dark web or Silk Road type stuff. That's not what we're going for. So I think, Cami, like I think it's just going to be a really interesting conversation that's going to get played out over years about how we do this and how regulators get appeased and how we figure out ways that the common consumer can go and use a website, a front end from a trusted intermediary that is able to access these protocols in a way that keeps everybody satisfied. But I really don't think there's any answers to it right now.
Agreed. And I think broadly, there's very strong alignment between DeFi and regulators. Regulators want like transparent, fair, efficient markets. They're just operating on like a environment that was built on COBOL, decades ago, right? Like it's just we have different tools, we have different software and different approaches to coordination now that can produce those outcomes. And squashing that innovation is not the thing that we want to do, because the outcome that we can achieve through DeFi is orders of magnitude more fair and open and transparent markets than what we have with TradFi today. And so, we're aligned with regulators, right? Like the outcome we want is the same. It's just, the process that we need to go through to make sure that, the education happens and people understand what's going on.
Yeah, that's a great take. DeFi would be great for regulators if they only realized it. I guess they're kind of not looking at it in the right way yet. Hopefully they will. So we're coming to the end of the hour. But I do want to end with a more kind of forward-looking comments on if you can each just quickly go through what's the most exciting thing that you're working on now that users can expect from your protocols. So you can start.
Yeah, I don't spend like a bunch of time on Mirror these days. I do have like a couple of things that are coming that's going to be built on the Terra blockchain that's interesting.
Okay.
And my newest fancy is something to do with metaverses. And working on a metaverse project of sorts. Still trying to figure it out, so I'll say more when I know more.
Okay, something metaverse sounds good.
Literally.
Nice. Hart?
Yeah, well, we've been spending a lot of time on infrastructure for DAO treasury management. And it's like a really interesting concept. If you just zoom out and you're like, okay, honestly, 15 months ago, DAOs had no assets. And now you have these DAOs with billions of dollars of assets, but they have like no legal entity. If you wanted to write like if you want to do a fundraise, you can't write a legal contract with like an investor to do a fundraise. But you can embed the terms of that trade in a synthetic token, and that synthetic token could look like a convertible note. It could look like some sort of structured investment, like a token plus a call option, something that we talked about with the sushi community. So there's actually this really cool and really innovative use case of taking DAOs and writing like an on-chain DeFi native way to create structured products, financial products that allow them to borrow against or raise money against their treasury assets without directly selling them. And so there's a lot we're working on there that I think is really cool and really compelling.
Sounds super interesting. Okay, finally, Kain.
It feels weird to even say this because it's been so long coming that I almost don't even believe it. But today we finally went live on Optimism. So exchanges are live.
Congrats.
Took longer than we were hoping, but we're there. So everything came together, and yeah, we've got a scalable network to run Ethereum DeFi on now, which is amazing.
So people can go and trade Synthetix assets on Optimism.
Yep. There's only 3 assets now, so ETH, BTC, and Link. But one of the things the community will be working on over the next month or so is expanding the range of those assets. So yeah, super exciting. Sigh of relief to be finally done.
Nice. Awesome. Well, oh my God, this was an amazing talk. Like, I enjoyed this so much, learned so much from you guys. Really appreciate you taking the time. It's really a privilege to have, the co-founders of the greatest synthetic asset platforms on DeFi talking about the latest issues and what you're all working on. So thanks again. Thanks everyone for joining. Claim your POAP for the talk and tune in to the next jam session, which we're setting the bar high with these. I don't know I'll be able to keep this up, but thanks guys, really appreciate it.
Thanks, Cami. Appreciate it. See ya.
Thanks, Cami.
Bye.
Bye-bye.
Oops.